Hello and a very warm welcome to everyone. I am Shreya Agrawal and you are watching our curtain raiser panel, The View from the Top, Gaining from Disorder. Before I deep dive into discussion with this August panel, I would like to do some context setting on why we are doing this special series, Winning with Anti-Fragility. The resilient resists shocks and stays the same. The anti-fragile gets better. Some things benefit from shocks. They thrive and grow when exposed to volatility, randomness, disorder, risk, and uncertainty. This is an extract from Anti-Fragile, Things That Gain from Disorder by Nassim Nicholas Taleb. Nassim Nicholas Taleb believes that resilient characters can sustain and resist shocks, but those who are anti-fragile get better. The precarious ramifications of the COVID 19 pandemic induced India's socio-economic landscape to be recalibrated in an unprecedented manner and at an urgent pace. The need for the organization to be anti fragile has been amplified because an anti fragile company is like a muscle. Muscles easily wear or tear due to overexertion and crack under pressure. Yet, muscles that are injured in this manner regenerate and rise from the ashes like a phoenix to get back to the top. Digitization became the next normal or the new normal in this new landscape and the new model for all organizations to adapt to. This has been a boon for businesses with a massive rise in demand. Yet, like a balloon overfilled with water, some companies imploded because they were too fragile to get used to this change. Still, many have come out of it better than before to emerge stronger and more robust. And the odds are, decades from now, these institutions and organizations would still persist in thriving irrespective of fluctuations in the economy and any other unforeseen outlier events. Anti-fragility is about making sure that one's organization thrives for decades, regardless of any changes in the economy, be it highs or lows. But as with any desirable quality, it comes at a price, making the decision less straightforward. Experts posit that anti-fragility brings long-term benefits, but at the expense of short-term profit optimization. What are the strategies then for future-proofing businesses? How can businesses focus more on anti-fragility today than just mere resilience to deal with continued uncertainty and disruption industries? To discuss all of this and get answers to some of these interesting questions, I'm extremely fortunate to have with me Padma Shri Sanjeev Bikhchandani, founder of InfoEdge, also TIE Delhi NCR past president and current governing council member. Please also help me welcome Dev Khare, partner at Lightspeed India, also TIE Delhi NCR board member. Please also help me welcome Karthik Reddy, co-founder Blue Ventures and vice chairman, Indian Venture Capital Association. Gentlemen, it's my sheer pleasure and privilege to welcome all of you to this beautiful series called Winning with Anti-Fragility, and thank you for time and energy to this. My first question is really an open-ended one, and it's really about what exactly differentiates a fragile organization from an anti fragile one. In the investing world, many companies are looked at from an outside in perspective to gauge market share and profitability. So, from an armchair perspective, how does an anti fragile company look like from the outside? I'll perhaps begin with you, Sanjeev, and then get on to others.
Well, see, you discover whether you're fragile or anti-fragile usually after an event which tests your fragility. It's very hard, really, to. Most people don't do it beforehand. But if you've been through one recession, one meltdown, one shock, that's when you begin to kick the tires around this whole business of fragility or anti-fragility. Now, in our case, we've been around as a business or a going concern for 31 years, as Naukri for 24 years, right? And therefore, we've faced enough shocks that we begin to think about stuff like this. Okay, and now companies that last usually, see, what I like to say is that the difference between a good entrepreneur and a great entrepreneur is great entrepreneurs are durable. They last many decades, the companies they build, right? Or the companies they found. To be durable, see, to be a good entrepreneur, you got to generate returns, see opportunity. But to a great entrepreneur, a great company will look at risk with as sharp a focus as they look at return. So in good times, you look at return, but in bad times, say, hey, I didn't manage this risk very well, right? And if you're constantly looking at risk, you will think about antifragility. And the truth is, you look at risk when you're slightly scared. And you get slightly scared and you get a little seasoned if you've been through one or two difficult situations, right? Now, let's take the case of what InfoEdge did in the recent COVID crisis. So the first thing is, the truth is, as an entrepreneur, I'm very risk averse. I'm scared. मैं थोड़ा डरपोक हूँ. So I get cautious. I'm a bit of a coward actually, right? So the first thing that happened is that when these videos began to come out of Wuhan on my, IMA class, in a school class WhatsApp group in January last year, right? And then somebody said, hey, this thing could go global. And that's when I sat up and took notice. And in January itself, we took one resource in CSR and said, listen, can you spend half your day just tracking this? Every day we want MIS. What's happening on this infection, how this spreading, where's it going? Track global media, track online, track Twitter, track everything, and tell us. And every day an email would come with 10, 15 bullet points on a table. So within a week of the first video surfacing, we had begun to track it with a resource, half a resource devoted to it, right? The next thing that happened was that one day, if you recall, there was this very famous first recorded case in India where somebody came back on a flight from Milan, and carrying the disease, and then went to, the Hyatt Hotel in Delhi for a meal, then went to Mayur Vihar, then went to Noida, then went to Agra, right? Now, the moment that case was detected, what happened in our instance, one of my colleagues, a senior colleague, he sent an email to Hitesh one day, or he called up Hitesh one day, and said, hey, listen, I have just got my wife was cabin crew on the flight from Milan, right? Now, I think the flight came on Jan 25th, and this was directed on the first week of Feb. And my wife has got an email saying she should quarantine at home for 3 weeks or 2 weeks because she was cabin crew on that flight, the flight that carried this person who had the disease. So since she's been at home and I've been meeting her, I think I should also quarantine and work from home. And this is early Feb, right? Last year. And that's when he sat up and took notice. It's coming close. It's coming because it's happened to somebody who was on the flight with this patient, and therefore this person is quarantined, therefore our guy is quarantined, right? So we figure out maybe we may have to migrate to work from home. So we did everything and we migrated to work from home, right? Around March 10th, 2 weeks before. Okay, the light has gone on my place. If you can still see me, it'll come back, but it takes 30 seconds. We migrated to work from home on March 10th, around March 7th, March 9th or 10th, full 2 weeks before the government mandated the lockdown. So we had time to prepare for work from home. We were therefore a little bit more anti-fragile than we would have been otherwise. Okay, so the truth is, to be anti-fragile, you have to be slightly paranoid, slightly risk-averse. You begin to think about it. You begin to think about it, you'll take action on it. Now, the truth also is that, look, in the case of Naukri, we saw a decline of 44% in billings YOY. Okay, in the first quarter of last financial year, in the first lockdown. Yet, because our business model was robust, and we, in spite of that fact, we were profitable. And therefore, the second thing we did was we talked to our CFO and said, listen, let's stress test how much money do we have, and in a worst case scenario, assume zero revenue, zero collections, zero marketing expenditure. Assume we don't downsize or let go of anybody. How long can we last? And he came back with that model and said, in that extreme scenario, we can last 3 years. If you don't let go, don't give increments, don't let go of anybody, zero revenue, zero marketing expenditure, right? And we said, okay, if we can last 3 years in this circumstance, we will not let go of anybody, right? And so we did not. As things happened, Q2 business we didn't go to zero. Q2 business are going to come back. We were okay. But the point is that our margins are so good and we always collect money 100% advance. Now, all of this was possible because we had built a product and offering and a value proposition where we could command those terms of trade, those prices that gave us those margins. So therefore you are anti-fragile if you are slightly paranoid and very good.
Okay,
Right?
thanks for that
You're
perspective.
anti-fragile. You're anti-fragile if you're diversified. Okay. So for instance, right now business is looking reasonably good in Naukri, and the reason is because IT and IT hiring, not just by IT companies, IT skills being hired by non-IT companies, because the digital transformation story is real. So even non-IT companies are hiring lots of IT people. Okay. So because we're diversified across all industries, right? In Naukri. So while something is in the doldrums, IT is doing very well, and that is lifting us. So anti-fragility, in our case, just three instances, but just come from three things. We are slightly paranoid, so we locked down early, before we were required to, and we prepared for it. We are anti-fragile because we built a great product. There is so much needed, and people are dependent on it that they will pay us in advance and pay us the price that gives us the margins. We are anti-fragile because we're diversified. And if I look for more reasons, I'm sure I can come with 5 or 6 more, but I'll stop here because I don't want to take up too much time. So in the case of Naukri, ये 3 कारण हैं.
Okay,
और भी
thanks for
हैं,
that.
but these 3 I will highlight.
Okay, thanks for that, Sanjeev. I come to you now, Dave. We just heard Sanjeev and he spoke about 3 clear reasons. And he started with, thinking about risk and return with the same lens, being paranoid, being sort of really paranoid about things. He spoke about stress testing their capacity. And at the end of the day, they have high operating profit, with which they could actually sustain for 3 years without doing anything. I want to understand from you that, taking the reference from what he just said, what exactly comes to your mind from an armchair perspective when you look at so many companies in your portfolio other than yours? What really constitutes an anti-fragile company?
Thanks, Shija. I think just to set context, sort of the way I thought about your question on anti-fragile versus fragile was across sort of our portfolio of investments. As an investor in early stage technology companies, we've got about 75 companies in India that we've invested in, and about 300 companies globally. And we saw how they reacted to the shock of the pandemic in different parts of the world and in different sectors of the economy in India. And I mean, I was thinking there's 3 or 4 things that define those companies that benefited, or benefit is the wrong word, that actually took the shock in of the pandemic and then um, came out with goods or services to offer that made sense during the pandemic. So, 3 things that stood out for me. One was scale out capacity. So, the ability to expand or decrease what they're doing very fluidly. And that's been enabled by things like the cloud, AWS, and all that, where you can expand and scale out capacity or bring it back in if demand decreases. And in some of these businesses in India, demand exploded. Online education is an example of that. Social media and entertainment is an example of that. Online grocery shopping and online e-commerce is an example of that post the first wave. And these companies had to really expand quickly. So they had those systems in place that could do that, and weren't as reliant on only people to do everything. There was technology that could help them expand. So that was one. Perhaps that comes back to the point you made on digitization becoming really important for all sorts of companies. The second thing was bottoms up or decentralized decision making. We saw this as a pattern across the companies. Those companies that were very centralized at the top, and all decisions had to go through, 1 or 2 people. And by the way, that's not an unusual thing, or not. It's not even necessarily a bad thing. It's just a way companies are. They succeed sometimes by being decentralized, sometimes by being centralized. But what we saw in the pandemic was those that were decentralized, where there were lots of small teams that could come up with their own ideas, build out new products, and launch them without too much, governance from other parts of the org. They could experiment quickly, kill those experiments that didn't work, and invest more investment in experiments that did work. So there was that. And then the final one was those businesses that define their business more broadly, and could therefore take in new lines of business within that, did better. So for an example of that would be, Baiju's in our portfolio, where the business is defined as educating kids online, right? More broadly, right? It's not only educating kids through pre-recorded videos or only educating kids, not live or live in a live streaming setting. It wasn't that narrowly defined as education. So they launched live sessions because all these kids were now at home, and so on and so forth. So they experimented quickly and did that. Another example is a company called Zetwork, which is a virtual factory marketplace that we have. They've stitched together thousands of small SMEs and factories across India. And during the pandemic, they could move demand across all these factories, and react to demand from different industries: EPO, construction, energy, water, utilities, all of these industries that needed manufacturing done for them. Depending on how those reacted, this company could react. So they were diversified across all of these types of demand. So those are some examples. ShareChat is another example. Within 3 days of the TikTok ban last July, they launched a product called Mods that had short video as well. And that was because they have lots of decentralized teams. And those teams came up with this idea. And within 3 days, they didn't know this ban was coming, right? Within 3 days, they launched it. So those are just some examples. Scale out capacity, bottoms up, decentralized decision making, and a broad enough view of the business such that you can bring in other types of new products and new services very quickly. Those are the three things that for me come to mind in terms of
Thanks for that, Dave. That's a pretty meaningful observation. And taking it further from what Sanjeev just added, being paranoid, scale, and diversified, I'm adding Dave's observation. He spoke about scale, decentralized decision making, and diversification. Karthik, coming to you, what really you think, what really happened, how your portfolio perhaps in tech reacted to it, and what really are the traits for an anti-fragile company in the hindsight if you look at it?
I think my friends here covered most of the things, so I won't try and repeat what they said. Everything was on point. I feel the best companies did most of the best practices that they put in place were on the lines of what Dave and Sanjeev said. The only thing I would characterize what they said in a slightly different way, which is, I think even the smallest of companies, Sanjeev, of course, speaks from obviously a 20-year-plus companies lens, very different from what a small cash-burning company is going through. But I think tech startups per se, I mean, I'm not giving them too much credit, but it's just the nature of who they are as a living, breathing being, tend to be on the sinusoidal wave kind of path, which is never smooth. It's always scrappy, but thankfully always ascending if they've survived till a particular point, right? There's no way it could have been flat. It couldn't have been simple. There's no nice, cute curves or lines. And as a result, they, like what Sanjeev said, they're better trained mentally to sort of deal with all of these ups and downs. Every fundraise is like pulling teeth for a founder, right? Every hiring gap or every person who leaves, everything feels like a day-to-day sort of crisis situation. So I think they're in general better equipped to deal with just the emotional highs and lows of these kind of situations. And so they tend to be a little bit more anti-fragile than regular organizations. Also, their ability to adapt to technology into their workflows and the way they function and the average ages of their workforce obviously made it a little bit more easy for them to adapt, I would argue, than traditional businesses. Now, that said, there were like the 3-4 sort of flavors of risk that creeped in, right? Some were just sectoral things. You couldn't control what you can't control. I mean, so travel or mobility, everything just shut down to zero. And so you could have been a great company. So everything got bracketed into 3 buckets. So either you had tailwinds or headwinds, and within that it was not like a 2x2, but almost like a 2x3. You had tailwinds or headwinds, and then you had either a lot of cash in the bank, you got lucky, you just raised a quarter or a few months ago, or you have a lot of resilience in the business model. So not to the extent of Sanjeev's level of profitability at InfoEdge, but perhaps close to that. So you can control burn, you can pull the runway for much longer. In some cases, even the best of companies, so best versus worst, had no money, just timing. You were going to raise supposedly on March 15th. There were companies which lost term sheets. They lost, term sheets vanished in that 2-3 weeks. Verbal interest just disappeared. Everyone went to coma, shock, right? At least temporarily for about 3 months. And so anything could have happened. And I think the folks who dug deep within and found that, they were tailwind driven and they had the resilience, all the characteristics that my peers have mentioned out here, they really dug deep and came out of that. And I think one of the biggest strengths we've seen in startup founders are incredible ability to learn. So as VCs, what do? You can't do much. You can't even get to their office and give them a pat on their back. So we just threw as much learning tools as possible at them for like 45, 60 days. Just bombarded them. So everyone here, Dipinder, Hitesh, in fact, then, Sujit, not Sujit, I think one of the Udaan founders, Sameer Nigam, PhonePe, everybody spoke to our founders. We got like 10, 15 of them and said like, not every one of our founders have gone through this, but we have some Maharathis sitting there. Let's lean on them. Because giving me some gyan as a VC is not going to really help the founder. They need to hear it that, hey, you can survive this. I think it was, it's difficult to draw a tight correlation, but I think it helped, right? And you need a support system. You need to believe that you can come out of this. And then everybody pitches in and you're all jointly motivated and inspired to say that, Dhanda hai to somehow paisa nikal ke, we'll bring it to the table. And most businesses which survived those 3, 4, 5 months, I think really revived phenomenally well. If they were in the tailwinds.
Yeah, you see, the truth is that last year in April, we had no idea how long it will last, right? Which is why we did the stress test and said, how long can it last if there's zero revenue? Not that, there will be zero revenue, but if there was, what will happen? So, and therefore, actually, to some extent, it's about waiting it out. And if you could wait it out, even though you're going crazy and really tense and stressed, if you could wait it out, you survived. Because the business did come back in quarter 2. But in quarter 1, April, we had no way of knowing what will happen.
Exactly. So my question to you and to this panel, really, I think we had a very interesting opening question. A lot of meaningful observations came out of it on sort of what truly qualifies an anti-fragile company, how startups also have been very quick to adapt to that compared to larger organizations. Sanjeev, my question to you really is that, you run a highly profitable listed internet company. If you look at your numbers, and if I look at operating profit numbers, visually it's a true testament to the health of the organization, 300 odd crores. Contrast that with a loss-making company like Zomato, which got listed. When you listed InfoEdge, to Zomato being listed now, and that too getting such stellar oversubscription. So what really has changed? How has Zomato or these companies defied the assumptions that you have to go for a NASDAQ listing where the valuations are perhaps appreciated better? Has the Indian retail investor become far more discerning? And does that really mean that the ambitions of the likes of other internet companies will only become higher? As someone like me who has tracked the private markets, my only fear with the Zomato IPO is that there will be a flurry of private companies wanting to go public, thinking that they would replicate that success. And there's perhaps nothing worse than a bad IPO. So I want to understand from you, and please answer these questions because I really wanted to ask you this.
Okay, there are many, many questions, and I've forgotten half of them, but let me just take a stab. Okay, so look, when we see every time a different type of company goes public, right? And it's the first of its type in India, it does need to do some sort of groundwork, which is somewhat pioneering in talking to investors, figuring it out. And then your success will hopefully breed further successes because you say, hey, this can work, so I can also work. So we went public. Now, there wasn't a flurry immediately, but in the next several years, I think, basically there would have been a flurry, but for the global financial crisis, which came within 2-3 years of our listing, right? And that sort of disrupted everything for a while. But Make My Trip went public, Just Dial went public, India Mart went public, Matrimony went public. 4 went public, but it took 10 or 12 years after us. Okay. What is different now? Now, we had to do a lot of pioneering work with investors, explaining to them, but this is not IT services. This is not software product. This is internet. And Indian investors, institutional investors, didn't really get it. However, because American investors got it, and European investors got it, and people based in Singapore and Hong Kong got it, our IPO succeeded because there was demand from there, and then the Indian investors also came in because they saw demand from there. Said, okay, it can work. Second, we probably had underpriced the IPO because we ourselves didn't want to take a risk, and our stock price doubled on day one. I mean, we gave it 320, went to 628 on day one, right? But it's okay. We were still happy that, okay, we probably put a price higher. We left some more money on the table, and when we might have wanted to. But these things are unpredictable, and that set the stage. Okay, fine. There is a category called an internet company in Indian market. Now, can a loss-making company go public in India? Well, the truth be told, there were several TV channels, media companies that had gone public in the past and were loss-making. So it's not as if this is the first time in India. And those shares did do well for a while. But the fact also is that, look, if you don't sustain your growth or you don't have visibility of profit after some time, your share price will get soft. That's what the TV channel companies have shown to us in the past, right? So Zomato and other internet companies go public will either have to get to profit within 2-3 years or grow fast on top line, or both, right? For the moment, Zomato's strategy is to go for growth. And I think there are a good, credible plan there. But the truth also is that Zomato can turn on a dime and make a profit when it wants. So in COVID, so again, antifragility, Zomato's business model is diversified. They had revenue from restaurant listings and advertising. They had revenue from Zomato Gold. They had revenue from delivery. Right? What did they do? The restaurant shut down. So no dining out, which meant Gold also lost its value prop, but they had delivery. And that began to fire. And then they said, okay, fine, we are going to up our take rates there, our margins there. They began to charge for delivery. They began to reduce the discounts. So in the beginning, orders went down, but their revenue went up. When their revenue went up, they got very close to profit. And then they said, okay, we've got all this money, we don't need to make a profit, let's go for growth again. So they were able to adapt and do this. Right? So now what will happen to all these companies? Look, each company is different. Some will do well, some will do really well. Some will achieve their targets and plans in the next 2-3 years, some may not. Will everybody not meet targets? I don't think so. Will everybody meet their targets? Maybe not. So each company has to look differently. And I would not hesitate to sort of say that the entire class is great or the entire class is bad.
Okay, so you're essentially saying that every time a new internet
Okay,
company...
sorry, one more question asked, so retail investor. So understand, Zomato only had 10% allocation for retail investors. It had 15% for HNIs. The remaining was for institutions, either in the QIB portion or in the anchor book. Institutions, many of them came from overseas, many came from India. There are quotas for each. But they all believed the long-term story. That's why they came. So it's not as if there are people who are waiting to dump the Zomato stock. Because a big part of the book was institutional. Right? Now, Cartrade India is going public next. Right? August 9th to 11th, the IPO is open. And I wish them well and all the best. And it's a fantastic achievement. And I hope they succeed. Right? Having said that, in that instance, I believe, this is what I was talking to somebody and he told me, I have not independently verified it, so take this with a pinch of salt. I believe, because it's a profitable company, 50% of the book is reserved for retail and HNI. Right? As opposed to 75% in Zomato, in institutions. That may be a different texture of IPO and what happens afterwards. We don't know. But it's a good company and it's profitable.
Sure. I wanted to bring you in, Dave, here to sort of point that Sajeev sort of mentioned. He said that either you have to be profitable the next 2 or 3 years if you become listed, or you have to choose growth. Perhaps the Indian investor base is becoming a discerning investor and giving some credit to organizations choosing growth over profitability. That's always been a constant kind of slugfest with internet companies or cash burning companies. My question to you really is that we all love the Zomato IPO. What has that success meant for you? And did you have any conversation with your investor companies or your internal boardroom meetings? What does that really mean for the VC ecosystem?
Yeah, I'll add a couple of the obvious points, and then maybe a couple of others. The obvious point with the huge success of the Zomato IPO, and kudos to Dipinder and the team, and Sanjeev and the team at InfoEdge for backing them. What it's opened our eyes to is that fast-growing category leaders in India do have demand from institutional and retail public investors. Our view before that was that maybe it would be very, very difficult for loss-making companies to go public in India. But I think people in the last 20 years, the market has come to understand what internet companies do and what their huge impact-making potential is. And so there is demand for that. I think international institutions, Indian financial institutions, Indian HNIs have all sort of come to understand. So the surprise was that there is more than enough demand for this and understanding of these sorts of businesses. And you don't have to be profitable to go public. Our view was you had to be 3 years profitable, all that stuff. I don't think that's needed. So that's one. The second is that there's a supply-demand imbalance between public internet stocks and that are available to public investors, and then the demand for those for internet, and there's a voracious demand for it, and there just isn't enough supply of internet companies. I think there's going to be there's a lot of demand there, and I think supply-wise, I think in the media and also in the investor community and even broadly in the startup community, the question has been, why aren't there bigger, more profitable internet companies in India? And that question was being asked 10 years ago or 15 years ago when the internet was still early in India. But now enough time has passed. We have enough companies that have reached some scale in the market in all sorts of sectors, food and education and media and commerce and B2B and enterprise software, SaaS, and so many. There's a huge broadening that's happened that now there are companies available to go public. And car trade is one that Sanjeev talked about. There are many others that are being talked about in all these sectors I mentioned. So I think there's plenty of supply coming up of companies. That's very exciting. And then what it means for us, very core, is that as investors, we want our companies to become large and self-sustaining over time. They can't, at the end of the day, keep burning cash, right? The definition of a good business is a high free cash flow business. One definition of a good business is a high free cash flow business. And so if you can do that as a public company, and then, give your employees, value for the ESOPs or the equity they own in a company, your founders and promoters, crystallize their equity, and then also for investors, all that capital will get invested back into the startup ecosystem and really grow the startup ecosystem, which to me, at the end of the day, in India, is actually is helping develop the country. Very, very different from what happened in the US, where the internet came along, well after the country was developed. In India, technology companies are helping develop the country, which I think this IPO sort of wave right now will help drive even further.
So great. So there have been some realizations and some learnings on part of VCs also with the Zomato IPO. I'll come to you now, Karthik, but just one quick question that since we have Sanjeev here. Sanjeev, in your past interviews, you've also spoken about the fact that, Zomato also went through a huge challenge, a huge challenge of survival. A lot of questions were there. Capital was a constraint, for instance, hugely funded competition. I was there, the first lockdown, COVID. But I want to understand, at what point in the hindsight do you think, would you qualify, two questions, would you qualify Zomato as an anti-fragile company, in the sense, can it sustain what it has achieved? And number two, what was that watershed moment or watershed moments where you realized that now they are perhaps on the right path? Because they also
Look,
had huge survival challenges.
yeah, so look, I think for us at InfoEdge, you see, I had to keep I was continuously under a microscope of the board because I was spending shareholder money investing in all these startups. So there was always questions asked of me. I think the first instance when we got a notion that we may maybe onto something really good. I mean, I always knew that they were really good, but the first justification I would give, publicly and to the board was, hey, Sequoia's coming. So when we went solo in the first 4 rounds, and then Sequoia came in, and that's when I said, hey, there's external validation. So that's one thing. That was one milestone. Second milestone, I think, would have been around 2015, when around September, October, when the Chinese market wobbled. And there was, for 3-4 months, I don't know if you recall, Karthik and Dev, there was some amount of softness in the private funding market for a few months in India, right? At that time, Zomato said, okay, fine, we will pivot to lower burn and higher, because we may need to make this company, this money last longer, the same money that we have. And I found they were able to do it in 2-3 months. I said, okay, so if they can pivot on a dime like this and, just very quickly go to very low burn, it means that the day you decide to sacrifice discounts and growth a bit, you can get to profit. That tells me it's an anti-fragile model, right? Then again in 2019, maybe 2018, they were in this competitive situation where, there was a big ticket, big checks back in the, back in competition. Yeah, and they again were forced to do the same thing, and they did it quite easily. And then when this restriction came on Chinese investments, they had to do the same thing. And then when COVID happened, it was the same thing. So I saw repeatedly that, they can become profitable at will. So it's okay. So if you can do that, you can go for growth, you can burn capital, but if crisis happens, you can become profitable anytime. It's a good model, right? Just cut the discounts, and you're okay. And start charging a delivery fee, okay. Right? And that's what told us that, look, this is okay. All these, I mean, it was not one day, but it was several over several years. All these experiences we had.
So the ability to sort of stop growth and become profitable at a time, as you
I would say stop growth. I would say, go to more prudent unit economics at will and get to profit.
Okay. I think all of you also sort of alluded to the fact that there is liquidity in the environment. Both Dev and Sanjeev sort of spoke about it, that there is so much demand from investors, from people who want to see more internet companies, and there is supply and demand imbalance. So capital can be a huge competitive advantage. 2 years back, perhaps one could have said that access to capital is a huge differentiator. But now there's perhaps an innate realization from the founders that as if we're operating in a world where capital is not only limited, capital is not limited, rather that's super abundant capital. So how does one maintain sanity, leave alone anti-fragility here? And I have sort of tracked this space for about 10 years or a decade, and I see this repeating. But this time, what I find extremely the big revelation that comes to me, there's one bucket which says that the VC industry is frothy, overheated, it's gone bonkers. But what I've also heard, that the size of the outcomes really support the quote-unquote frothiness in the cycle. There's one investor who actually told me that the category defining companies used to typically exit at $1 billion to $5 billion. But now those outcomes are $10 billion to $30 billion or higher. And I wonder, what is the view of this panel? Are we in a bubble, or is this the new normal for VCs? I'll begin with you, Karthik. Get on to Dave here, and then on to Sanjeev. Yeah.
So I think so taking off from where the previous question left. So public markets are not places where you sort of terminate a journey, but begin a very long-term phase of your journey, if you ask me. And so there are enough and more examples where, starting with our friends at InfoEdge itself, where 10 baggers have been built in the public markets, right? So we somehow see it as a novelty in the country because of all of these historical perceptions that you can't take loss-making companies to the market, they're not large enough. And now collectively, it's not like magic moment happened. It's like how everything, the penny dropped the day Geo was launched, and a lot of things fell in place around that point in time. Similarly, 2020, 2021, the endemic growth of the sector combined with 15 years of effort is what's brought it to this point. So it's not like car trade hasn't been around for 10 years. It's not like Zomato hasn't been around for 12 years, etc., etc. So a lot of the scaling has taken its time. Of course, there are unicorns born 3 years ago. I'm not denying that. But basically, the scale has been developed over a period of time. The fundamental building blocks of those were not present before. It's not easy to go and hire 500 engineers, even if you had the money, say 7 years ago, who had a certain caliber of experience in the market at will. Today, you've trained 100 times those engineers using venture capital money over a decade. So it might feel magical that it's happening suddenly, but I think it's 10, 15 years of work by the entire ecosystem. And the penny is finally dropping rapidly everywhere, right? And you're suddenly seeing a whole bunch of companies go public at 3, 4, 5 billion. The challenge is whether we can actually create 5 baggers, 10 baggers like Sanjeev did from that point of public issuance. Otherwise, the markets will, slam these stocks eventually. You have to be able to show 20, 25%, a balance of growth and path to profitability. So what I call, to my founders, I call this the Hdfc model, that you're able to show, a 30% year-on-year growth to perpetuity. The market's large enough if you've stabilized the business model. And enough companies have shown that before cool tech came along. So if you're able to stabilize that and keep growing, a company which is, you don't have to generate the same, 100x that you did from 10 million to a billion. A billion to 10 billion is a phenomenal journey. The flip of that is that once you've established a market leader, like a Zomato, every business that actually replicates Zomato-like economics has a chance of going public from the point of 500 million. Who stopped us? It's all just mental blocks, right? So I think what happens is suddenly, you're right, more and more options for capital do open up. The path to public opens up, and it should happen much, much earlier. So my prediction is not just that 20 of the 40 unicorns will go public in the next few years, but you will have a slew of smaller companies like Teamlease, InfoEdge. These were all IPO'd much before they were $1 billion in size. Why did suddenly the odds change in 7, 10 years? So that's my thinking. I think there's a massive opportunity. You can't entirely rely on private capital to keep driving you up that path. And I think that's what everyone is eventually coming to, right? Everyone needs an exit. Everyone needs a cycle. And you need massive access to capital and public markets to continue building for perpetuity. And Sanjeev had a point, I guess, on that.
Yeah, Sanjeev had a
Yeah, I think you got to also appreciate the fact that SEBI is more receptive now to loss-making companies, a certain kind of loss-making company, a certain kind of IPO with higher share of institutional shareholding in PC. So I think regulatory, the regulation also is more friendly to this sort of IPO. We have to recognize that also. That wasn't the case maybe 10, 15 years ago.
Okay, that's a quick point coming here. Dave, I think I want to understand your point on capital as a competitive advantage. Is it a reason that investors are not using the B word? I mean, which camp are you in? Is this the new normal for VCs? Should we just be happy with that fact because there are larger outcomes? Or do you really think that there's a fraud that exists?
Yeah, I mean, that's the, I guess, $1 million question, or $1 billion question maybe is the better word these days. I think there'll be lots of different views out there. We'll see where the world ends up. But over the last 20 years of investing, I've seen so many cycles. There was the 99-2000 cycle, the 2008 financial crisis cycle in India. There was a cycle in 2015-16 as well. And for personally speaking, I don't think we're at the end of cycles. We are not at the end of history when it comes to cycles. It'll happen. I think what we have now is cheap, abundant capital coming in from Wall Street, essentially, from the hedge funds and the very, very large pools of capital that almost dwarf the amount of capital that used to exist inside venture capital funds to date. So that amount of cheap capital is coming in and sort of changing the way the game is played in a sense. Having said that, your question was, should we now normally expect 20 to $30 billion exits going forward? I certainly don't think so. However, there are some fundamentals of venture capital investing that might lead to larger outcomes. And now that we have more and more companies being funded, we might have more of those sorts of outcomes. There are three sort of principles. One is companies that have, or projects that have uncapped upside. When we look at companies, we can because of sort of having looked at so many over time, we can sort of sense which ones are just not going to be able to power through 100, 200, 300,000 crores of revenue per year. Versus others that have, gigantic markets that they're going after. In our portfolio, you mentioned Oran. That's $1 trillion market in India of B2B trading that occurs that is wholly offline. And that's coming online, as an example. So uncapped upside. The second thing is aggressive founders. Karthik alluded to this as well. Sanjeev alluded as well, that there's just a third generation of founders now out there who've built startups once or twice before and are coming around again. They're not building from a defensive posture. They are out there to disrupt and dominate categories. And they're doing it with a no holds barred sort of approach to doing that. And so that's very different from I think in general 10 years ago. And the final thing is models that innovate for India. I think we're seeing that models that didn't exist elsewhere that are being started in India and then copied elsewhere for that matter. We're seeing a lot of that happening on the internet. All of these, I think, will potentially lead to very, very large outcomes.
Okay, thanks for that. I sort of bring in Sanjeev now. Sanjeev, I think a lot of meaningful observations are coming here. Karthik's point was that while Zomato, it might have appended the playbook for investing that, okay, loss-making companies, fine, but you really can't have that to perpetuity. I mean, ultimately, you need to have flow, right? I mean, that is what makes it sustainable, large anti-fragile companies, so to speak. And Dave's point was also that all of this is also looking good because we really have cheap, abundant capital coming from the Wall Street. I want to understand from you, Sanjeev, that ultimately, okay, while startups are getting disrupted with this pandemic-induced growth, the reality is that the VC model itself is getting disrupted. The way you have retail companies being Amazoned, you have VCs being soft banked, for instance. So what really is the future here, for the super abundant capital industry? Your viewpoint, and then turn to the last round of questioning.
So I was making that. I was going to make a point that, look, you got to remember that the Fed has introduced $4 trillion into the global economy, well, into the US economy, which has found its way globally, all over the world. Second, you got to understand that American money is kind of a little wary now of going into China, and that some of that money is coming into India, right? And this is leading to, honestly, valuations both in public and private markets, which would not have existed otherwise, perhaps, right? So if you look at InfoEdge, what was our share price in pre-COVID, say Jan, Feb 2020? 2,600, 2,800, right? Since then, we've done a QIP. So on a fully diluted basis, the share price is 2x of what it was, and which means that actually it's 2.2x something, 2.3x. Now, fundamentally, is the company in a better position, 2x better position than it was in Jan, Feb 2020? I don't know. It's debatable. We feel proud that there are 60 unicorns in India. I don't know how many they are, latest number. But would they have been 60 if this $14 not come in? I don't know. So I think Dave is absolutely correct when he talks about the world being awash in liquidity. And money like water will find its way wherever there's space available. Right? And the level is right. Okay. And should the liquidity dry up, which means capital becomes scarce at some point in time in the near future, to be anti-fragile, you have to game your model, game your company. And listen, if I don't get more money, or if I don't get that valuation, so I can't raise it, or I don't get as much as I want, what happens to my company? And if you're not doing that thinking, it's important to be aggressive, because you're an aggressive young entrepreneur, as they said, who wants to disrupt. It's important to be aggressive. It's also important to keep an eye on risk. And one big risk is, what if external capital dries up or reduces? Then how do I run my company? And if you're able to find those answers, right? And should it come to that, should push come to shove, you actually execute them well, then that is when you're anti-fragile.
That is what I think all the VCs are looking for. What happens when the music sort of really stops. I mean, it's very, I think.
But look, with $14 in the system, I don't know when it's going to stop. I don't know if it's going to stop. But look, we have seen this movie before, right? It will stop sometime. The question is that long enough for you to build a financially sustainable company? Where without external capital, you're still okay.
So does it look like the summer of 1999? That's the question.
Well, in the past, the Fed has, ever since the global financial crisis, has shown that it'll print its way out of trouble.
Okay.
Right?
I have really seen investors not using the B word. They will never come and say that, okay, this is a bubble. And I think we'll have to leave that argument at that. But I think, one key question...
Bubble is usually identified in hindsight. Bubble tha.
Bubble tha. We are not at the end of the cycle, as they also put it. So I think, one key question I have from all three of you is that, we have quite a few private companies prepping to go public. One key concern, or one key advice that you would have for the founder to watch out for as a red flag, so that it does not necessarily yield into a bad IPO? What would that be? I would start from you, Sanjeev, get on to you, Karthik, and then...
Look, typically when an IPO is done, you pre-prepped, you talk to the bankers. See, no banker wants a bad IPO because it masks their reputation. If they're underwriting the issue, then, they take a balance sheet risk, right? So a banker will typically err on the side of caution while telling you how to price your IPO, right? And you will know what investor feedback you're getting, because a lot of this, the bankers were sorted out, what's going to work, issue RI, what do you think, right? And so typically, if you're smart and prudent and you don't force an IPO, right? IPO should do all right. Unless, of course, the market tanks, in which case, all bets are off. So I think a prudent investors who are already in the company, the venture capitalists, the PE guys, I think a prudent entrepreneur, working with a prudent banker, the IPO should go through. Because nobody wants a bad IPO. Okay,
so do not force the IPO. This is your key.
Yeah, do not force an IPO where it's not going to work, where you're pricing it too high, where the demand is, going to be soft, right? After the issuance, right? Do not force an IPO.
Okay, so Karthik, we just heard from Sanjeev. What would your thing be, and then I'll get on to Dave. Yeah.
Same thing. I'm a little old school. I hate this argument that you milk the IPO to perfect price. I hate the Silicon Valley argument around this, that IPOs are underpriced, you leave too much money on the table. I feel it's the job of a great path to public company to leave money on the table. You can't just make all the private capital that ever came into your company a bunch of money, milk that out, and leave all the public guys who are going to hold this for the next 5 to 10 years dry with borderline profits. Everybody needs to make money to be happy in a stock and hold it for very, very long, right? And so this argument that for diluting 10-15% of primary that you have to squeeze out the last drop of valuation out of the market, I find is absolutely silly. Right? There's other 85% is well protected. You can perform. If you perform, your stock will run 5x anyway. Nobody has lost any value. The other 85% of the value is intact. So for that marginal optimization of how you can raise a little bit more money for that primary dilution in IPO, people, trying to perfect an IPO price is just silly. So that's my advice to IPO-bound founders, that don't try to squeeze out every rupee. Leave something for the public markets as well. And then the second part is, I don't think the challenge with history was not, yes, SEBI has been generous, I accede to everything. But let's look at ourselves in the mirror. I don't think that the companies were remotely ready to go IPO mindset-wise. It had nothing to do with numbers. There was no preparation to actually face that public scrutiny. Right? We weren't even in a position to share headline numbers with the market. Right? So that mindset has to change. You have to be ready to now share your numbers every day with whoever asks. That's the role of a public company. So if you're not ready to do that, please don't go IPO. Right? There's no hiding. There's no masking. There's no funny metrics. There's P&L, and there's like the ability to defend it. Right? You don't like that, don't be a public company. So those are my 2 tips for IPO founders.
Okay, Dev, you heard both Sanjeev and Karthik both making their points. Sanjeev's argument was that don't force fit the IPO. And Karthik also mentioned that if you're going public, you have to be ready for high scrutiny, quarterly earnings, and perhaps very high scrutiny from the public investors if you're ready for that. So Dev, your advice, cardinal sin to be avoided for a bad IPO, for IPO-bound founders.
Yeah, look, I haven't gone through an IPO myself, so far be it for me to give advice on this. The only thing I'd say, and we give this advice to any founders who are raising capital, whether in the public or private markets, is take care of your stakeholders, especially your employees. They are the engine that are going to drive growth, and therefore distribute ESOPs as widely as you can throughout the organization, down to the lowest rung in the organization. And let everybody participate in the upside here. I think that's a change that has yet to come in the Indian internet economy. ESOPs are still reserved for only a portion of most employee bases. I'd love to see it be more abundantly available to everybody. And then everybody can benefit from these IPOs and then be incented to work well beyond the IPO. Back to Karthik's point that the IPO is just a financing point for a company that's going to go on for decades potentially.
Okay, great. I think we had a very interesting conversation today. We began with sort of traits of antifragility. We spoke about capital as a competitive advantage. We spoke about how the Zomato IPO has upended the playbook, what should be the learnings for VCs. We spoke about what the cardinal sins to be avoided, not to have a bad IPO. We also spoke about the fact that this entire slug is profitability. It's been a pretty interesting conversation. And I think the good summary to all of this really will be that what we are seeing in the market right now is that whilst there is super abundant capital, and one might argue that this is really driving so much of what we're seeing in the market, the outcomes are getting larger, ambitions are getting higher. And some of this is also seeing precedent from what's really happening in the other markets. For instance, this entire question of what's really happening in China. Let's talk about regulation for a bit now. We spoke about quite a few things. The recent China turmoil, its impact on India and Indian businesses, when foreign capital flow from India to China. That is one aspect of the question which comes from the audience. And I think the more important part, which I think a lot of people are interested in, is that what do leaders like you think that do domestic businesses need protection? A level playing field, as cost of capital is different in different markets. I'll begin with you, Sanjeev, and then get on the panel.
There isn't any imminent danger of foreign capital flowing from India to China. In fact, it's the other way around, given what's happening in China, given what's happening to US-China relations. And maybe some of that is happening. Maybe that's why there is more American capital coming here. Okay, so I don't think there's a risk of that. There is, of course, Karthik alluded to it, that fundamentally outcomes are also better because companies are larger. And companies are larger because the internet is more penetrated. And to a large extent, we have to thank Geo for that, right? For making data so cheap, and then others following suit. So I think, a whole bunch of things that come together, and therefore, 2021 is not 2006 when InfoEdge went public. It's a very different environment.
Okay. Dave, do domestic businesses need protection or level playing field? What would your response to be to that question? That's a question from the audiences.
Yeah, I mean, it's a question that's fraught with lots of nuances. As a principle, certainly think that the market should have level playing fields. Foreign sort of entities should not be advantaged, or local entities should not be advantaged. Everybody should be able to play in an open market. That would be the classic sort of approach to this thing. Having said that, the way China, notwithstanding the last couple of weeks, has built up sort of its internet economy and closed it off in a sense from the rest of the world and let its own sort of giants emerge, is a model that's out there. Another model is the US model, where there have been lots of global market leaders that have emerged, potentially because that was the first economy that went internet, that got the internet in a sense, right? And so I generally don't believe in protection, but equality and equal playing field, whether it's from a tax perspective or regulations perspective, should be in place in general. I mean, SEBI, other regulatory organizations in India, everybody's gone towards that. Even sort of Aadhaar and UPI and the whole initiative there from the RBI and NPCI, all that has been amazing at leveling the playing field between startups and large organizations, between Indian companies and foreign companies. And so yeah, I'm all for that. I'm less for protectionism. I think Indian companies can be very strong and compete very effectively globally, and they've shown that in the past.
Okay, Karthik?
Yeah, I think I agree with Dave that we're at a cusp of proving that we can't not only compete with the best in the world inside onshore, but even take those battles offshore, right? And so if we have almost a dozen unicorns in the B2B SaaS space building off American customers, then we can't be complaining about necessarily not giving the same kind of playing field for those players if they want to come into India. And historically, people have committed very long term to India. I don't think have come and muddied the waters. They've actually helped those sub economies grow, whether that's been retail or insurance or any of those segments, right? There are very few sectors where I think that kind of protection is warranted, and I think we are building entrepreneurs who are capable of taking these battles to the world and arguably building multi-billion-dollar companies, global stage. Forget about India. So I think that confidence is set in. Funnily enough, from an IVCA lens, I complain to government that the Indian investors don't have a level playing field relative to international investors. So even as an industry, the venture industry says that we have so many boundary conditions put around us, whereas foreign money can come in and out very freely relative to our capital. So to Dave's point, yeah, you just level the playing field in every direction. You shouldn't give one side or the other, put more frictional challenges for anybody to operate. And I think we will have a robust, economy with a fair share of wins going to the Indian entrepreneurs and the Indian investors, is my take.
Okay. Thanks for that, Karthik. I think before I wrap up, I do a quick rapid fire. And I think that's something that we should do to have a fun element to this extremely insightful conversation. So I'll start with you, Sanjeev. How long is your anti-portfolio? Everybody knows about your winning list, especially the Zomato IPO, how much you made. But tell me, how long is your anti-portfolio?
Well, there are 8 to 10 companies that come to mind. Okay, and I've said no to so many good ones. Okay, so I said no to Flipkart in pre-series A without meeting them. I said no to Snapdeal twice at 28 million. I said no to Ola in the pre-series A after meeting Bhavish. I said no to Taxi for Show on the pre-series A. I said no to Go Mechanic in the pre-series A. I said no to Myntra twice. Before when he was doing t-shirts and mugs. Okay. I said no to to, three, four others which are not really, really big and valuable, right? And my reason for saying no was if I don't know how these companies can make a profit, right, I should not be investing. Not that they should make a profit, I should at least know how they will make a profit or could make a profit.
But then you invested
No,
in
no, no,
Zomato.
no, no, no,
So you seem to have
no, no, no.
changed.
Zomato, I said I know how it can make a profit. Not that it will make a profit. I know how it can make a profit. If in my head I can't get that, how can they make a profit? I said we should not invest. Now, in all these cases, I was right. They did not make a profit, but we would have made a profit as investors. Okay. Yeah. So, but the point, but the way I look at it is that you shouldn't worry about the ones you said no to. You should worry about the ones you said yes to. How are these guys doing? And just focus on it.
Coming to that, one comment from any of your investing companies founder that has stayed with you forever.
So look, I'll tell you two comments from our prospective investors when we were doing a Series A and our auditor when I was hunting for an auditor, right? And these are some of the best comments I have, best pieces of advice I've got in my life. So, we were a break-even company. We were making a 1.8 lakh profit on a 36 lakh turnover when we did a Series A. I was not taking a salary. If I had taken a salary, then we'd have made a loss, right? So one of the things that ICICI Venture said to us is that, listen, we want a big five auditor. Okay, and then there were five. And we had a no-name auditor who was quite reasonable in commercial terms, right? Friends of mine, basically. People who had been senior in school. I knew them. I was comfortable. And I kept fighting it, and they insisted. So then I went shopping. I spoke to every one of the big five. Somebody asked for 5 lakhs, 10 lakhs. And I said, are you crazy? That's 5 times my last year's profit. Okay. So finally, I met Kaushik Datta of Pricewaterhouse, partner. And he said, what do you want? I said, I want an audit in 1 lakh. He said, done. But 2, 3 things. I said, what? He said, as you grow, you will allow me to increase my fees every year till I reach my normal fees. Without you not negotiate with me every year on next year's fees. I said, okay, fine, no problem. But this year I want this. Okay. Then he said, you will not be, because I'm getting only 1 lakh, I should not have to work extra hard for you, which means you will tell me the truth. You will always tell me the truth. And you will understand that your auditors and your independent directors are there to save you from yourself. If you give me this commitment, I'm on. So your auditors and independent directors are there to save you from yourself is one of the best pieces of advice I've ever got. So regard them, listen to them, understand their concerns.
Okay. My last question to you in a quick one. One advice or one word of caution for Deepinder of Zomato on sustaining antifragility. It is one thing to hit a pop, but the real game is to sustain it. And public markets are discerning investors.
Oh, Deepinder knows it already. Okay, he's gone into it with eyes open. He knows what he's doing. And I'm confident he has it in him to build a really great, big, profitable company. So I don't need to advise him, actually.
You don't need to advise him. Is that what you're saying, Sanjeev? You
Absolutely.
still own 15% of the company. You haven't sold much.
Yeah, that's so we are staying because we're confident of the management team.
Okay. I come to you now, Dev. A Zomato-like IPO from Lightspeed India portfolio. What and when?
Yeah, I mean, I can't comment on IPO plans for any of the companies. There are lots of companies that have scaled, not just in our portfolio, but across, Karthik's portfolio and broadly across venture invested portfolios in India. And like I said before, I'm very excited that we're going to see these IPOs across lots of different sectors. As I mentioned, healthcare, education, retailing, media and entertainment, B2B trading, all of these will see IPOs over the next few years. So I literally cannot, I don't know who's going to go public when, but lots of exciting big companies getting built. But I just wanted to make one funny point. You said one thing we heard from founders. Funniest thing I ever heard from a founder was on a board meeting was, Dave, I'm sorry, we're profitable.
That's amazing. That was my next question to you. That's hilarious. Okay, my other question to you was that, after Zenoti and Innovator, can we expect to see more product companies emerging from India? What would your viewpoint be there?
Is that for me, Shuja?
Yeah, yeah.
Oh, for sure. I mean, there's so much going on, and product is a very broad term. Lots of SaaS companies. We mentioned two. Freshworks, obviously, is another one, and many others behind it. Hundreds of companies that are out there. I think there was a McKinsey and then another BCG report on SaaS. India could be 10% of the world's SaaS revenue in another few years. So that's a very strong sector. Product also comes to consumer digital products. For me, social media products, education products. These are pure digital companies, also are product companies. And so there's a big future for that as well.
Okay. Oyo, Byju's, Uran, and ShareChat. One company which is not necessarily yours, but has caught your attention despite your stellar portfolio.
Definitely. I mean, there's so many of those. I mean, the anti-portfolio, which is the same question, another form. There's so many of them. It's unreal. Our business is we're very fortunate to be in the business, but we also get it wrong like 80% of the time. And so we've missed a lot of the names that Sanjeev mentioned, a lot of other names out there. And the only thing we can do is keep learning. And the nice thing in India is that there's lots of new models coming. And so, there's always something new to learn. So, but I can't name any one company. There are tons of very, very interesting companies. I would point the attention of your viewers to a lot of the B2B segment, not just software, but B2B marketplaces. A lot of these are not talked about because they're not as understandable as consumer companies. But there's a lot going on in this B2B economy in India, and it's actually much larger than the consumer economy.
Okay, that's fair point. Karthik, I come to you. The most defining trend for the next decade for tech in India, what would that really be from your perspective?
I think it's already happening, but I think the fact that we are able to take technology to the outside of the first 150 million people in the country, right? And it becomes truly transformative when it reaches small businesses and the so-called, lower middle class and the poorer classes of society. And I don't even think we have scratched the surface on that. We've had phenomenal successes in microfinance, etc. When that's actually accelerated by technology, I think it becomes very, very powerful. And this year, I've witnessed a lot of that in the way small businesses have started collecting digital payments from me, etc. And you can see that it's very transformational in the way they engage with technology. And education, similarly, payments. So essential goods, day-to-day essentials being handled through technology is very, very powerful in this country.
Okay. What is one thing that you like the most about this discussion today?
I think the fact that founders need. I mean, I think it's very glamorous when you sit in. The 80% of media coverage is around fundraising, but the reality is the bulk of the work, 95% of the work, is around day-to-day sustenance and firefighting in 18 different directions. And none of those fundraisers is easy, right? Until it gets to the broadsheets and gets printed online or broadsheet. So the fact that we are digging deep into understanding what the challenges of building an anti-fragile company, challenges of taking these companies to public markets is very essential narrative. And I hope the coverage shifts to just evaluating the public life of these companies going forward.
Okay. I also want to ask you that, and I think I can ask you this because I was the first one to do a story on you about a decade back. You were a startup in the startup VC fund space, right? One key learning that you have had, and you have learned it the hard way in this world, what would that really be?
No one listens to you until you actually have enough success under your belt. And that's every constituent of the ecosystem. It's sad, but it's true. So for all the love we get, it doesn't matter until you actually succeed.
Okay. And I think let's end on a lighter note. What are you Netflixing these days?
I was watching this Finnish crime serial. It's pretty horrendous, so I'm not going to advocate it to anybody. Yeah, but you need something to lighten the load, I guess. So I went through, binge watched one season of that. And then if you're a sports buff, you should watch Drive to Survive, which is like watching Formula One like a masala movie. So it's all fun and games.
Okay. Thank you, Karthik. Thank you, Dev. And thank you, Sanjeev, for sparing your time and energy to this. I think we had a very wonderful conversation on winning with anti-fragility fees. And this was the Curtain Raiser panel and a very always fun and great choice. And thank you so much. Till the time I see you next, goodbye and good luck. And
Bye.
thank you for our audiences for being so patient and thanking for your questions. Thank you. Bye-bye.
Thanks for having us. Bye-bye.